Hello friends, today's topic is Other Deductions under section 36. In this section, we will be studying what are the specific deductions which are allowed to the SSC, wherein which includes insurance premium paid for business or profession by the SSC, health insurance premium paid by the employer on behalf of the employee, then the deduction of interest on borrowed capital, which will be allowed subject to certain conditions, the deduction of bad debts in the hands of the SSC, and so on and so forth. So friends, other deductions mentioned in section 36 of the Income Tax Act. Here there are specific sections which have been mentioned, specific heads which have been mentioned, under which the SSC will be allowed deduction specifically. On your screen, subsection 1, the deductions provided for in the following clauses shall be allowed in respect of the matters dealt with therein in computing the income referred to in section 28. So, such deductions under section 36 will be allowed against the profit and gains income under section 28. Clause 1 of subsection 1 of section 36, insurance premium paid. Any insurance premium paid by the SSC on the stock and stores which is used for the purpose of business or profession from saving it from damage or destruction will be allowed as deduction to the SSC. On your screen, the amount of premium paid in respect of insurance against risk of damage or destruction damage or destruction of stocks or stores which are used for the purpose of business or profession. So, risk of damage, risk of destruction of stocks or stores which are used for the purpose of business or profession will get covered under clause 1. Any premium paid on such stock on such stores will be allowed as deduction to the SSC. So any risk over and above damage or destruction is not covered. What is specifically mentioned under this clause only is covered. This you will have to keep in mind, that what has been specifically mentioned under the provisions of section 36 will only be allowed. Any other deduction, if it is for the purpose of business or profession and incurred by the SSC, not personal in nature, and several other criteria I fulfill, will covered under section 37, which is the residuary section. So section 36 covers specific deduction which is allowed to the SSC. First is clause 1, insurance premium paid on stocks stores used for the purpose of business, and the risk covered is damage or destruction. Clause 1A, insurance premium paid by a federal milk cooperative society. The amount of any premium paid by a federal milk cooperative society to effect or to keep in force an insurance on the life of the cattle of the members, on the life of the cattle owned by the member of a cooperative society. Any insurance premium paid on such will be allowed as deduction. Being a primary society engaged in supplying milk raised by its members to such federal milk cooperative society. So any premium paid by the federal milk cooperative society on behalf of its members for ensuring the life of the cattle which are used by its members for extracting milk for the purpose of supplying milk will be covered under Federal Milk Cooperative Society. So it is similar to a relation of employer and employee, wherein any insurance paid by the employer on the life of the employee or health insurance of the employee gets covered for deduction. Similarly, any insurance premium paid by the Federal Milk Cooperative Society on the life of the cattle of the members, life of the cattle which is owned by the members of the cooperative society will get covered for the purpose of deduction under section clause 1a of subsection 1 of section 36. Premium paid by employer for health insurance of employees. Any premium paid by the employer on behalf of the employee will get covered for deduction, and it should be paid to GIC, General Insurance Corporation of India, or any other insurer which is approved by IRDA, Insurance Regulatory and Development Authority, any other insurer which is approved by IRDA. Premium paid by employer for health insurance of employees. 1b, the amount of any premium paid by any mode other than cash. So this should be highlighted. By any mode other than cash by the SSC as an employer to effect or to keep in force an insurance on the health of the employees under a scheme framed in this behalf by, so on the health of the employees, scheme which is framed by GIC, General Insurance Corporation of India, or any other insurer, scheme framed by any other insurer and approved by IRDA. If this is the case, then premium paid by the employer to keep in force the insurance on the health of the employees by a mode other than cash will be allowed to the employer, and the scheme should be framed by GIC or by any other insurer which is approved by IRDA. Bonus and commission. Any deduction, any payment by the employer to the employee in the form of bonus and commission will be allowed as deduction based on payment basis. Meaning, based on payment basis means 43B, wherein certain payments, or you can say also statutory payments, are supposed to be paid before the due date of tax return. If it is not enough that it should be provided in the books, it should be actually paid by the SSC. It is only when it is actually paid by the SSC that he will be allowed the deduction. So section 36(1)(2) should be read along with section 43B. We will be discussing in detail when we cover section 43 in subsequent slides. So section 36(1)(2), payment should be made by the employer to the employee of bonus and commission. If paid, then deduction will be allowed, provided one condition being that such bonus or commission should not be in the form of profit or dividend which was supposed to be paid by the employer. Meaning, the profit or dividend which was payable are not paid in the name of bonus and commission. If it is so, then it won't be allowed. This provision has been inserted to keep a check on a private limited company wherein the profit or dividend nature of payment is profit or dividend and they are paid in the name of bonus or commission. So it should be actually bonus or commission. You can say as per the terms of the contract. It may have been included as per the terms of the employment contract. Bonus or commission may have been included, and accordingly the same is paid by the employer to the employee. It should not be paid. The profit or dividend should not be paid in the form of bonus or commission. Any sum paid to an employee as bonus or commission for services rendered where such sum would not have been payable to him as profits or dividend if it had not been paid as bonus or commission. Meaning, again, that we have discussed is, meaning is the nature of payment should actually be bonus or commission. The nature of payment, if it is profit or dividend and it is only paid in the name of bonus, then it won't be allowed to the SSC, to the employer. So bonus or commission paid by the employer to the employee will be allowed as deduction to the employer under clause 2, subsection 1 of section 36. Interest on borrowed capital covered under clause 3, wherein any interest paid by the SSC post installation of the capital asset, for example, Any interest paid on the borrowed capital will be allowed as deduction under clause 3, and it goes without saying that the such asset is used for the purpose of business or profession by the SSE. Any expenditure before installation of the capital asset won't be allowed as deduction under this clause. It will be capitalized and allowed depreciation. Also, we have to read clause 3 along with explanation A to section 43, wherein it has been specifically stated that interest relatable to a period after the asset is put to use, interest after capital assets installation cannot be capitalized, meaning indirectly such interest amount paid after installation of the capital asset will be allowed as deduction to the SSE as per explanation 8 section 43(1), which states definition of actual cost. Accordingly, such deduction will be allowed under clause 3 of subsection 1 of section 36. On your screen, interest on borrowed capital, clause 3, the amount of interest paid in respect of capital borrowed for the purpose of business or profession. The capital is borrowed for the purpose of business or profession. It could be for the purchase of capital asset or any other purpose, provided that any amount of interest paid in respect of capital borrowed for acquisition of an asset, in case of acquisition of asset, whether capitalized in the books of accounts or not, meaning as per Companies Act or under any of the provisions of the Act or method of accounting regularly employed by the SSE, if the asset is, for example, not capitalized in the books of accounts. However, any asset purchased by the SSE will qualify under clause 3. The definition of asset is already given in section 32, tangible asset, intangible asset, for the income tax law. So for acquisition of an asset, if any interest is paid, whether capitalized in the books of accounts or not, for any period beginning from the date on which capital was borrowed, for acquisition of the asset till the date on which such asset was first put to use, meaning till the date of capital asset installation, it shall not be allowed as deduction. So any interest from the period the loan was taken to the period when asset was first put to use shall not be considered for the purpose of deduction of interest amount. As per Proviso to clause 3, explanation, recurring subscriptions paid periodically by shareholders or subscribers in mutual fund societies, mutual benefit societies which fulfill such conditions as may be prescribed shall be deemed to be capital borrowed within the meaning of this clause. Note, as per explanation 8 to section 43(1), interest relatable to a period after the asset is first put to use cannot be capitalized. So as per explanation 8 of section 43(1) as well, it is clear that amount should not be capitalized. The amount which has been incurred post the asset is put to use cannot be capitalized. It will have to be allowed as deduction under clause 3 of subsection 1 of section 36. In the case of, just a second, explanation 8 to section 43(1), in the case of the genuine business borrowings, the department cannot disallow any part of the interest on the ground that the rate of interest is unreasonable, is excessive, is unreasonably high, except in cases falling under section 40A. So if the loan has been taken for genuine business purpose, it cannot be argued by the department, it cannot be argued by the assessing officer that interest paid is excessive, is unreasonable, subject to provisions of section 40A. So friends, this was clause 3, wherein interest on borrowed capital for the purpose of business or profession, any amount borrowed for the purpose of business or profession will be allowed as deduction as interest paid. Now friends, clause 3A, which is discount on zero coupon bonds. In this clause, the discount on zero coupon bonds will be allowed on pro rata basis. Pro rata basis meaning basis the period of the life of the zero coupon bonds. Meaning, first of all, the discount amount. Discount amount is the amount received by the company on issuing the zero coupon bonds, let's say 100, and the amount which is payable by the company on redemption of the bonds. Difference between the two will be nothing but discount. So the amount received by the company at the time of issuing the zero coupon bonds and the amount which is payable by the company at the time of redemption. The difference between the two will be discount, and such discount will be allowed on pro rata basis, and such discount will be prorated based on the period of the life of the bond, and it will be allowed, say for example it is for 10 years, then the discount amount divided by 10, the discount amount will be allowed in 10 equal installments under clause 3a of subsection 1 of section 36. So friends, zero coupon bond is nothing but no interest or no other benefit will be provided to the investor, meaning the interest amount will be zero, and such bonds are issued by infrastructure capital fund, infrastructure capital company, public sector company, are issued by specified person for the purpose of investment in infrastructure. So on your screen, clause 3a, the pro rata amount of discount. The pro rata amount of discount on a zero coupon bond having regard to the life of such bond calculated in the manner as may be prescribed. So the pro rata amount of discount will be allowed as deduction during the period of life of such bond to the SSC. Meaning of discount: difference between the amount received or receivable by a infrastructure capital company who is issuing the bond, infrastructure capital company, infrastructure capital fund, or public sector company or scheduled bank issuing such bond, and the difference between amount received and amount payable by such company at the time on maturity or redemption of such bond. So discount amount is the difference between the two. Period of life of the bond is period commencing from the date of issue of the bond and ending on the date of maturity of the bond. This is the period of the life of the bond. Discount, meaning of definition of discount and period of life of the bond for the purpose of clause 3a. Meaning of certain terms in section 2. What is infrastructure capital company? What is infrastructure capital fund? Has been defined under section under clause 26a. Infrastructure capital company is nothing but the company which has been engaged as per provision of subsection 4 of section 80IA, 80IAB and 80IB. These provisions are related to infrastructure company, telecom company, company engaged in generation of power, company engaged in housing project, company engaged in developing of SEZ. On your screen, infrastructure capital company means such company which makes investments by way of acquiring shares or providing long-term finance. So investments by way of acquiring shares or providing long-term finance to any enterprise or undertaking wholly engaged in. So long-term finance is provided to enterprise engaged in the business referred to in subsection 4 of section 80IA, 80IAB, or undertaking, developing and building housing project mentioned in subsection 80IB, or a project of constructing a hotel of not less than 3-star category as classified by central government, or a project constructing hospital with at least 100 bed for patients. So here you can see 80IA, which is mentioned below, a developing of SEZ, housing project, hotel project, and hospital with at least more than 100 beds. So for this infrastructure project are covered in infrastructure capital company. So infrastructure capital company providing long-term finance to such infrastructure projects will be covered under clause 26A. Section 80IA, which is subsection 4, which is mentioned under the definition of infrastructure capital company, developing, operating and maintaining any infrastructure facility fulfilling the specified conditions, providing telecom services whether basic or cellular, developing and operating or maintaining and operating an industrial park or SEZ notified by the central government, generating, transmitting or distributing power, or undertaking substantial renovation and modernization of existing network of transmission or distribution lines. Generating, transmitting or distributing power, developing, operating, maintaining industrial park, SEZ, telecom services and infrastructure facility are covered in subsection 4 of section 80IA. Apart from 80IA, 80IAB, SEZ, 80IB, housing project, hotel project, hospital is covered under the definition of infrastructure capital company. Clause 26B, Infrastructure Capital Fund. Infrastructure Capital Fund is similar to Infrastructure Capital Company. Only thing is the nature of the entity is trust. And in clause 26A, it is the company. So such trust, such capital fund is providing long-term finance to infrastructure companies mentioned in 80IA, 80IAB, 80IB, which is hospital, hotel projects, housing projects, and other infrastructure companies. On your screen, Infrastructure Capital Fund means fund operating under a trust deed registered under the provisions of Registration Act, established to raise monies by the trustee for investment. So till here it signifies that it is a trust for investment by way of acquiring shares or providing long-term finance to any enterprise or undertaking wholly engaged in the business referred to in subsection 4 of 80IA, 80IAB, which is SEZ, housing project, 80IB, constructing a hotel not less than 3-star, and constructing hospital not less than 100 beds, which is same as clause 26A. So friends, discount on zero coupon bonds. Bonds can be issued by infrastructure capital company, infrastructure capital fund, or public sector company or scheduled bank, and the discount over the period of the life of the bond will be allowed to be prorated in equal annual installments to the SEC, which is issuing the bond. Now, contributions to provident and other funds. Contribution by the employer to the provident and other employee welfare scheme. Contribution of the employer contribution as well as the employee contribution in the hands of the SSC, which will be allowed as deduction in the hands of the employer only if the payment is made to the fund which is related to health welfare, which is related to employee welfare scheme. So the schemes covered are provident fund, superannuation fund, pension, gratuity. Under clause 4, that is mentioned over here, under clause 4 of subsection 1 of section 36, it covers provident fund and superannuation fund. So here the normal procedure, there will be a provident fund which should be approved by the concerned authority, and to such a fund employee contributes as well as employer contributes. A matching contribution is made by the employer as well. So the employee contributes. The way of contribution by the employee will be employer, while paying the monthly salary, deducts the employee contribution. So 100 rupees is the basic salary, is the salary payable on month basis by the employer to the employee. So employee contribution is deducted from the hands of the employer, from the hands of the employee. So effectively 90 rupees is received by the employee, and 10 rupees is supposed to be deposited in the provident fund account of the employee. So before it is deposited to the provident fund account, such rupees 10, in our example, such rupees 10 is considered as income of the employer under section 224. Under section 2 clause 24, the same will be considered, the employee contribution will be considered as income of the SSC till the time it is deposited in the provident fund account. And when it is deposited in the provident fund account by the employer, it will be allowed as deduction in the hands of the employer. Again, the employee contribution, which is deducted from monthly salary of the employee, rupees 10 in our example, this rupees 10 before being paid to the provident fund account of the employee will be first considered as income of the employer under clause 24 section 2, and once it is paid to the provident fund account, it will be considered as deduction under clause 4 of subsection 1 of section 36. So first consider it as income in the hands of the employer, and then a deduction will be allowed in the hands of the employer under clause 4 of section 36(1) once it is paid to the approved provident fund account. Similarly, for superannuation fund scheme, which is applicable for provident fund, will also be applicable for superannuation fund. On your screen, any sum paid by the SSC, which is employer, by way of contribution towards a recognized or approved recognized provident fund or an approved superannuation fund, subject to such limits as may be prescribed, which is 12% in the case of provident fund, for the purpose of recognizing the provident fund or approving the superannuation fund as the case may be, and subject to such conditions as the board may think fit to specify in cases where the contributions are not in the nature of annual contribution or fixed amounts, annual contribution on definite basis by reference to the income chargeable under the head salaries, or to the contribution, or to the number of members of the fund. Meaning, till here you can see that any sum which is paid by the employer by way of contribution towards recognized provident fund will be allowed as deduction to the employer, whether employee or employer contribution will be allowed to the SSC to the employer in the year of contribution. Fine. And the employee contribution. The employee contribution that we just spoke, wherein it is considered as income and then allowed as deduction, it is required to be provided to be deducted under section 36(1) only because it is first considered as income under section 224. That's why a deduction is required to be provided of employee contribution under section 36(1). So as per clause 4, any sum paid by the employer by way of contribution to recognize provident fund or approve superannuation fund within the prescribed limits will be allowed as deduction to the employer, and the prescribed limits are for the employer contribution. Now clause 4a, employer's contribution to the account of employee under pension scheme referred to in 80 CCD. Again, employer's contribution will be allowed as deduction to the employer SSC, where the amount is paid to an approved pension scheme under section 80 CCD within the prescribed limit, which is 10% of the salary paid to the SSC. Any sum paid by the SSC as an employer by way of contribution towards a pension scheme. So this is employer contribution towards pension scheme under section 80 CCD on account of an employee to the extent it does not exceed 10% of salary of the employee in the previous year. So the prescribed limit is 10%. It should not be exceeding. Anything excess of 10% will be disallowed as per section 40A(9). So the deduction under clause 4A is limited to 10% of the salary of the employee, and the deduction available is of employer's contribution only. For the purpose of this clause, salary includes DNS allowance if the terms of the employment so provide, but excludes other allowances and perquisite. This is for the purpose of calculation. This is for the purpose of calculation of salary for computing the 10% limit. And on this definition of salary, the deduction, the employer's contribution is required to be made. The employer's contribution on pension scheme under section 80 CCD. Note 40A(9). As we have discussed, anything above 10% under pension scheme will be disallowed. Under section 40A(9), provides for disallowance of any sum paid by employer towards contribution to any fund or trust has been amended to exclude from the scope of its disallowance contribution by an employer to the pension scheme referred to in, to the extent of which deduction is allowable under section 36(1)(4)(a), meaning 40A(9) is applicable wherever there has been excess employer contribution. Anything excess of employer contribution will be disallowed, except for 80 CCD, which will be not disallowed till the extent of deduction claim under section 36(1)(4)(a). Again, which provides for disallowance. 40A(9) provides for disallowance of any sum paid by an employer towards contribution to any fund or trust has been amended wherein contribution by the employer to the pension scheme in 80 CCD will not be disallowed to the extent of deduction allowed in 36(1)(4)(a), meaning anything above 10% only will be disallowed. Till 10% nothing will be disallowed, and deduction can continue to be claimed under section 36(1)(4)(a) by the SSC. Contribution to gratuity fund. Any contribution by the employer towards approved gratuity fund under irrevocable trust will be allowed as deduction to the employer. Clause 5. Any sum paid by the SSC as an employer by way of contribution towards an approved gratuity fund. So the gratuity fund should be approved. It should be paid by the employer. It should be the employer contribution. Any contribution in the gratuity, there is an employer contribution only, wherein from the day the employer joins the company, ideally provision is made by the company year on year for the purpose of payment of gratuity after 5 years. So effectively an employee is eligible for gratuity amount only after 5 years of continuous service with that particular employer. And employer generally, there is a provision of gratuity made on year basis by the employer. So any payment, not provision, any payment to gratuity fund, any payment by the employer to an approved gratuity fund will be allowed as deduction to the SSC. So let's take an example wherein the employee is with the employer, was with the employer for 5 years, and thereafter he is resigning. Thereafter his services have been terminated. So after that, since you can say the gratuity is available, is eligible to be paid after 5 years, the employer will have to transfer funds to a gratuity fund, make payment to gratuity fund. Any amount paid to a approved gratuity fund by the employer, you can say in brackets, on account of employee completing 5 years and on termination of the employee, bracket closed, the same will be allowed as deduction to the SSC. And the fund towards which it has been paid, it should be in the form of trust, irrevocable trust. Clause 5. Any sum paid by the SSC as an employer by way of contribution towards an approved gratuity fund created by him for the exclusive benefit of his employees under an irrevocable trust. This was contribution towards employee welfare scheme, which covered clause 4, clause 4a, clause 5. Clause 4 was for provident fund and superannuation fund. Clause 4a was related to pension scheme under section 80 CCD. It covered only employer contribution. Clause 4 covered employee as well as employer contribution. Deduction of employee and employer contribution will be allowed to the SSC employer. And clause 5 is related to employer's contribution to approved gratuity fund under an irrevocable trust. Now friends, clause 5a, which is related to employees contribution to welfare fund, as we had discussed in clause 4, wherein the employee contribution will be treated as income of the employer, and it is only when it is transferred to the respective fund before the due date, then it will be allowed as deduction to the employer. So clause 5a is the clause wherein the employee contribution deduction is allowed to the employer. Previously we had discussed that clause 4 is related to employer and employee contribution. No, it covers only employer contribution, and employee contribution is covered under clause 5a, and the due date before which the employer is required to make the payment to the respective fund will be the due date of the provident fund scheme, will be the due date of the respective fund scheme. For example, the due date for contribution to a provident fund is 15th of succeeding month. So the word due date used in clause 5a is related to the due date of contribution of the respective fund and not due date of filing of return of income. On your screen, amount received by SSC as contribution from his employees towards their welfare fund. So this is employee contribution. Clause 5a. Any sum received by the SSC from any of his employees to with the provisions of subclause 10 of clause 24 of section 2 apply, wherein in this section the employee contribution is treated as income of the employer. If such sum is credited by the SSC, the deduction will be allowed of employee contribution if such sum is credited by the SSC to the employee's account in the relevant fund or funds on or before the due date. So only if the employee contribution is credited by the employer in the relevant fund before the due date, on or before the due date, only then deduction under clause 5a will be allowed to the SSC. Explanation: for the purpose of this clause, due date means the date by which the SSC employer is required to credit the employee's account to the employee's account in the relevant fund under any act, rule, order or notification issued thereunder, or under any standing order, award, contract of service or otherwise. So the due date means the relevant fund due date and not return filing due date in the relevant fund under any act, rule, order or notification issued thereunder. So employees contribution deduction will be allowed to the SSC under clause 5a, and the relevant fund is or could be any welfare employee welfare fund. Any welfare employee welfare fund is covered under clause 5a. Now friends, allowance for animals in clause 6, where animal is used by the SSC for the purpose of business or profession and such animal is no more usable or useless in the previous year. In such a case, whatever sale value has been obtained by selling that animal and the original cost price of the animal, meaning the difference between the two, cost price minus the sale value at the time of sale. Cost price minus sale value will be, the difference amount will be allowed as deduction to the SSC under clause 6. The intention being, this will enable the SSC to purchase new animal in place of the old animal. Clause 6, in respect of animals which have been used for the purpose of business or profession, used for the purpose of business or profession, otherwise than as a stock in trade, and have died or become permanently useless for such purposes, the difference between the actual cost to the SSC of the animals and the amount, if any, realized in respect of the carcasses or animals, the difference between the two will be allowed as deduction to the SSC under clause 6 of subsection 1 of section 36. Bad debts, clause 7. The deduction of the bad debts which has been actually written off in the books of accounts of the SSC, which is not recoverable. So, a deduction under clause 7 of subsection 1 of section 36 will be allowed to the SSC subject to certain conditions. First condition being, the bad debts should be written off in the books of accounts as irrecoverable by the SSC. Also, the debt should be booked, first of all, should be booked in the books of accounts. Meaning, for example, sale made by the SSC on credit. The entry would be details account debit to sales, wherein sales is the income, and accordingly, and further to the example, this debtor is considered after 1 year as not recoverable. Accordingly, the sales which was made on credit by the SSC, the amount is not recoverable now, and such amount was written off in the books of account, was provided in the books of accounts of the SSC as bad debts. So, first of all, the income of sales was booked previously in the books of accounts. Income was booked, accordingly, tax thereon was paid by the SSC, right? So, one of the conditions of claiming deduction under clause 7 is that, first of all, the income corresponding to the debt should be booked in the books of accounts, and then bad debts, the bad debt should be provided, should be written off in the books of accounts. These are the two conditions for claiming bad debts under clause 7. Also, there are proviso being mentioned under clause 7, wherein the banking financial institutions which are required to make provision as per clause 7a, provision to bad and doubtful debts. In those cases, to the extent of provision of bad and doubtful debts, no deduction will be allowed. Only if the bad debt amount is more than the provision of bad and doubtful debts, the difference amount, the excess balance, will be allowed as deduction to the SSC. Meaning, let's take an example where provision for bad and doubtful debts is 10 rupees, and the bad debts written off is 15. So anything in excess of balance of provision for bad and doubtful debts will be allowed as deduction under clause 7. So 15 minus 10, 5 rupees will be allowed as deduction. If, for example, return of bad debt is 7, then nothing will be allowed as deduction. As per the proviso to clause 7, there is another proviso to clause 7 wherein certain income at times is required to be booked as per ICDS, Income Computation and Disclosure Standards, as per section 145. So it could be a scenario that a different accounting treatment is to be followed as per ICDS and as per method of accounting regularly employed by the SSC as per general accounting principles. So as per ICDS, an income should be booked in the books of accounts. However, as per normal accounting principles, such entry is not required to be booked in the books of accounts. So actually, if you see, ICDS is as per income tax law, and accounting principles is for the maintenance of books of accounts. And two conditions on which bad debt deduction is allowed is the entry should be income should be booked in the hands of the SSC and bad debt should be written off. So if as per normal accounting principles the entry is not allowed to be booked as income, then there will be no question of writing it off, and accordingly deduction as bad debt won't be available under clause 7. In such cases where there is a difference of practice between ICDS and normal accounting practices, as per proviso to clause 7, as per proviso to clause 7, it will be assumed that such debt has been written off, and accordingly the SSC will be allowed to claim the bad debt written off as deduction under clause 7. On your screen, clause 7, subject to the provisions of subsection 2. Also, subsection 2, there are two sections covered over here related to bad debts. First is 36(1)(7) and second is 36(2). So bad debts gets covered not only in subsection 1 clause 7 but also in subsection 2. The amount of any bad debt or part thereof which is written off as irrecoverable in the accounts of the SSC for the previous year. So the amount, the bad debt or any part thereof should be written off in the books of accounts as irrecoverable by the SSC, first condition. And second condition of booking the entry in the books of accounts is mentioned in subsection 2 of section 36. First of all, we will cover the proviso to clause 7, provided that in the case of an SSC to which clause 7A applies, this is the proviso related to provision of bad and doubtful debts, which we have discussed earlier, wherein only the excess balance of bad debt written off will be allowed. So in the case of such SSC for who are required to make provision as bad and doubtful debts as per clause 7A, the amount of deduction relating to such debt or part thereof shall be limited to the amount by which such debt or part thereof exceeds the credit balance in the provision for bad and doubtful debts. So anything in excess of credit balance in provision for bad and doubtful debts will be allowed as deduction. Provided further, this is related to ICDS, changing in practices between the booking of income as per ICDS and normal accounting principles. Provided further that where the amount of such debt or part thereof has been taken into account in computing the income, has been taken into account in the computing the income means the sales entry has been passed, debtors account debit to sales of the SSC of the previous year in which the amount of such part thereof becomes recoverable, or of an earlier previous year, it could be any year, on the basis of the entry has been booked on the basis of ICDS income computation and disclosure standards notified under section 145 without recording the same in the accounts. So as per normal accounting practices, this entry was not supposed to be recorded in the books of accounts, but only because of ICDS provisions, such income as per income tax law should be first considered as income in the books of accounts. Then, in such cases where there is a difference between provisions of ICDS and provisions of normal accounting practices, then such debt or part thereof shall be allowed in the previous year in which such debt or part thereof becomes irrecoverable, and it shall be deemed that such debt or part has been written off in the accounts for the purpose of this clause. So, as stated earlier, since there is a difference between the provisions of ICTS and normal accounting principles, the as per the normal books of accounts, the sales entry was not required to book. Accordingly, there will be no question of writing off such debt for such purposes. It will be assumed that such bad debt which is irrecoverable, which is not recoverable, has been written off, will be assumed to be written off as per second proviso to clause 7 of subsection 1 of section 36. So till now, clause 7 stated one of the basic condition of writing off the debt in the books of accounts. First proviso to clause 7 stated that debt amount should be exceeding the credit balance of provision of bad and doubtful debts. In cases of clause 7a, anything in excess of the provision amount will be allowed in the hands of the SSC under clause 7. And second proviso stated the difference between ICTS and normal accounting practices, wherein bad debts will be assumed to be written off in the books of accounts. Explanation 1. For the purpose of this clause, any bad debt or part thereof written off as irrecoverable in the accounts of the SSC shall not include any provision for bad and doubtful debts made in the accounts of the SSC. So any amount transferred to provision for bad and doubtful debts will not be considered that bad debt has been written off as irrecoverable. Explanation 2 for removal of doubts. It is hereby clarified that for the purpose of the proviso to clause 7 of this subsection and clause 5 of subsection 2, the account referred to therein shall be only one account in respect of provision for bad and doubtful debts under clause 7a, and such account shall relate to all type of advances including rural branches advances. So for the purpose of provision of bad and doubtful debts, the advances which are supposed to be included for the purpose of provision will include advances from rural branches as well as per the explanation 2. So including the advances made by rural branches, this will be this provision, this explanation will be more clarified when we do clause 7a, when we will discuss this clause 7a. At that point of time, this explanation 2 will also come into picture. Subsection 2. So at the start of the portion of bad debt, we had stated that clause 7 of subsection 1 of section 36 is applicable. It is related to bad debts. Also, subsection 2 of section 36 is also applicable, is also related to bad debts, which states one of the condition of booking the income in the books of accounts, of computing the debts in the books of accounts. In making any deduction for a bad debt or part thereof, the following provisions shall apply. No such deduction shall be allowed unless such debt or part thereof has been taken into account in computing the income of the SSC. So unless and until a sales entry is booked in the books of accounts, for example, a sales entry is booked in the books of accounts, no bad debts will be allowed. Bad debts which has been written off will not be allowed as deduction in the previous year in which the amount of such debt or part thereof is written off, or of an earlier previous year. So meaning earlier previous year means the sales entry, in our example the sales entry was booked 1 year earlier. So in the previous year 18-19 we had booked sales, we had booked credit sales, and after 1 year the SSC came to know that this amount was irrecoverable. So the portion which has been highlighted in clause 1, the previous year can be the year in which debt has been written off, or it can be earlier year as well. In our example, the earlier year is previous year 1819. So even the earlier previous years are considered for the purpose of deduction of bad debts written off. So, or the computation, the condition of booking the entry as computation of income is also applicable in case of represents or the deduction. No such deduction shall be allowed unless such debt or part thereof represents money lent in the ordinary course of business of banking or money lending which is carried on by the SSC. So this is exception to the exception, wherein the condition of booking a sales entry is not applicable to a person who is into money lending business, or the money lending is the ordinary course of the business of the SSC. Clause 2. If the amount ultimately recovered on any such debt or part of debt is less than the difference between the debt or part and the amount so deducted, meaning bad debt written off, for example, say is 100. However, subsequently, you can say after 5 to 6 years, you were able to recover certain amount which is 80. So, such a deficiency shall be deductible in the previous year in which the ultimate recovery is made. Meaning, if the amount ultimately recovered on such debt or part of debt is less, then the difference between the debt or part and the amount deducted. Again, total debt, for example, let's take an example over here. Total debt is 100, meaning debtors account debit to sales, the sales entry is of 100, and the amount which has been deducted, the amount which has been written off is 60. So the difference between the two, 100 minus 60, total debt minus amount deducted is 60. Difference between the two is 40. 100 minus 60, and this 40 amount is more than the sales value. Let's say 30. Sales value is 30. So the difference, which is 40 minus 30 in this case, will be allowed as deduction as per clause 2 of subsection 2 of section 36. Again, I will read this provision. If the amount ultimately recovered in an example 30 on any such debt or part of debt is less than the difference between the total debt and the amount so deducted. Total debt 100, amount deducted 60, difference between the two 40. This 40 amount is more than the sales value, or the sales value is less than the difference between the total debt and the debt deducted. Then 40 minus 30 in example 10 rupees will be deductible. The deficiency shall be deductible in the previous year in which the ultimate recovery is made. So the differential amount of rupees 10 will be allowed as deduction to the SSC as per clause 2 of subsection 2. Clause 5, as such that a part of the debt relates to advances made by an SSC to which clause 7a applies, no such deduction shall be allowed unless the SSC has debited the amount in that previous year to the provision for bad and doubtful debts account made under that clause. Meaning, we had discussed in the proviso to subsection 1 that only the excess credit balance, only the excess amount, then provision of bad and doubtful debts. Bad debt written off should be 100, provision for bad and doubtful debts is 80. Anything in excess only will be allowed as deduction under clause 7. And as per clause 5 of subsection 2, it says bad debt written off should be reflecting in the debit balance of provision of bad and doubtful debts. It's only when it is reflecting in debit balance, I mean it is adjusted against the provision for bad and doubtful debts, it's only after that that excess balance will be allowed to the SSC under clause 7. So it is an extension of the part of proviso that we had discussed in subsection 1, meaning if you have provided something in the books of account, if there is any amount reflecting in the provision for bad and doubtful debts in the cases of SSC under clause 7a, then first bad debt to be written off will be adjusted against such provision, and only the excess amount will be allowed as deduction under clause 7. This is to be read. So accordingly clause 5 of subsection 2 will be read along with first proviso which is mentioned over here. If these both are clubbed together, meaning would be any bad debt which is to be written off will be first adjusted against provision for bad and doubtful debts, and which will be first adjusted against provision for bad and doubtful debts as per clause 5 of subsection 2, and thereafter as per to subsection proviso to clause 7 which is highlighted over here. As per this proviso, only the excess balance of bad debt written off will be allowed as deduction under clause 7 of bad debts. Additional note: recovery of bad debt subsequently will be taxable under section 41(4). So here you have written off a bad debt in the books of accounts, let's say 100, and thereafter subsequently after 3 to 4 years you are able to obtain certain amount on the bad debt, and if such amount is more than the bad debt written off in the books of accounts, and if such amount is more than the bad debts written off in the books of accounts, then the excess amount will be treated as business income in the hands of the SSC. On your screen, if a deduction has been allowed in respect of bad debt under section 36 and subsequently the amount recovered in respect of such debt is more than the amount due after the allowance has been made, is more than the bad debts amount, the excess shall be deemed to be the profit and gains of business or profession and will be chargeable as income of the previous year in which it is recovered. So in the year in which it is recovered, the excess amount will be subject to tax, and this excess amount will be subject to tax even if the business of the SSC is not in existence. Whether or not the business or profession in respect of which the deduction has been allowed is in existence at that time or not, it doesn't matter. It is not necessary that the business should be in existence in the year of recovery. And accordingly 41(4) taxes the excess amount recovered on the bad debt which has been written off as per section 36 clause 7. Now friends, the next clause which is clause 7a, it is related to provision for bad and doubtful debts in case of specified banks. Specified banks are nothing but scheduled banks, non-scheduled banks, certain cooperative society, public financial institution, even foreign bank. So in this part, what happens is the provision made by such banks, the provision for bad and doubtful debts made by the specified banks will be allowed as deduction in the hands of the SSC, in the hands of the specified banks under clause 7a. So first and foremost condition is you have made provision for bad and doubtful debts in your books of accounts. Secondly, certain portion of either total income or total assets, certain portion of either total income or total assets of the specified bank will be allowed as deduction under this clause. So first is scheduled bank and non-scheduled bank and selective cooperative society. Scheduled bank is nothing but State Bank of India or its subsidiaries or any nationalized bank, and non-scheduled bank are other than scheduled bank. In this case, the deduction which will be allowed to scheduled and non-scheduled bank will be 8.5% of the total income or 10% of the aggregate average advances. Again, the deduction under clause 7A will be 8.5% of the total income of the scheduled bank, non-scheduled bank or selective cooperative society, 8.5% of total income and 10% of aggregate advance, aggregate average advances. Now what is aggregate advance or aggregate averages advances? In this case, what happens is the rural branches of the scheduled bank or non-scheduled bank are taken into account. Advances made by such rural branches are taken into account, wherein the monthly outstanding advance amount, the monthly outstanding advance amount is noted down for each and every rural branch. It is summed up. The total of each and every rural branch is divided by number of months. Once it is divided by number of months, the average is obtained. The average amount is obtained for each and every rural branch, and all such average advances, all such average amount is summed up, and this is what we call aggregate average advances. And 10% of this aggregate advance, average advance, will be allowed as deduction to the SSC to the specified banks. Also, as per proviso, as per proviso to clause A of 7A, 5% of the total assets of the scheduled bank or non-scheduled bank will be allowed as deduction, and a further deduction will be allowed based on remittance received from securities by the scheduled bank or non-scheduled bank. So this portion till now we have covered. As per subclause A, the deduction is available to scheduled bank, non-scheduled bank or certain cooperative society. For clause B, C and D, the provisions, the deduction which is available to foreign bank, to public financial institution will be 5% of the total income. On a screen, provision for bad and doubtful debts in case of specified banks. Clause 7A, in respect of any provision for bad and doubtful debts made by the specified banks, the provision for bad and doubtful debts should be provided in the books of accounts. Subclause A, a scheduled bank, not being a bank incorporated or under the laws of country outside India, it should be Indian scheduled bank or a non-scheduled bank or a cooperative bank other than primary agricultural credit society or primary cooperative agricultural society, primary cooperative agriculture and rural development bank, and certain cooperative society. In such specified banks, the amount of deduction available is an amount not exceeding 8.5% of the total income. Total income is to be computed before making any deduction under this clause in chapter 6A, and 10%, not exceeding 10% of aggregate average advances made by rural branches of such bank, computed in the prescribed manner. We have already discussed how it is to be computed, which has been mentioned in rule 6ABA of the income tax rules. So the amount of deduction for scheduled bank, non-scheduled bank, cooperative society is 8.5% of total income and 10% of the aggregate average advances made by the rural branches. Now, how to compute the aggregate average advances for the purpose of clause 7a of subsection 1 of section 36? It has been mentioned in rule 6ABA for the purpose of clause 7a of subsection 1 of section 36. The aggregate average advances made by the rural branches of a scheduled bank shall be computed in the following manner, namely, so rural branches, scheduled bank, the amounts of advances made for each rural branch as outstanding at the end of the last day of each month, meaning the monthly outstanding advance amount, the monthly outstanding balance shall be aggregated separately for each and every rural branch. Point B, the sum so arrived, which is total of the monthly balance of each and every rural branch. The sum so arrived at in the case of each such branch shall be divided by the number of months for which the outstanding advances have been taken into account for the purpose of clause A. So it will be divided by the number of months, and the aggregate of such averages, the aggregate of the sums so arrived at in respect of each of the rural branch shall be the aggregate average advances made by the rural branch of the scheduled bank. So here you can see all the average amount are aggregated and mentioned, and 10% is to be applied on aggregate average advances. Explanation: in this rule, rural branch and scheduled bank shall have the meaning assigned to them in explanation to clause 7a of subsection 1 of section 36. So friends, we have already discussed definition of scheduled bank, and the definition of rural branch is nothing but branch where the population as per the latest census is less than 10,000. Population being less than 10,000, that will be termed as rural branch. Now the provisos, as per the first proviso, 5% of the amount of total assets of the specified banks will be considered, and as per the second proviso, the redemption amount from securities will be considered for the purpose of deduction. First proviso, scheduled bank or non-scheduled bank referred to in this subclause shall, at its option, be allowed in any of the relevant assessment years deduction in respect of any provision made by it for assets classified by the RBI as doubtful debts or loss assets in accordance with the guidelines issued by it in this behalf, an amount not exceeding 5% of the amount of such assets shown in the books of accounts of the bank on the last day of the previous year. So the deduction which is allowable will be amount not exceeding 5% of the amount of such assets which are doubtful assets or loss assets as per RBI guidelines. Second proviso, scheduled bank or non-scheduled bank referred to in this subclause shall at its option be allowed a further deduction in excess of the limits specified in the foregoing provision will be allowed, amount not exceeding the income derived from redemption of securities in accordance with a scheme framed by the central government. So it should not be exceeding the income which is derived from redemption of securities. A further deduction can be claimed by the specified banks as per the second proviso. Provided also that no deduction shall be allowed under the third proviso unless such income has been disclosed in the return of income. So such income should be disclosed in the return of income for the purpose of third proviso, for the purpose of in the return of income. So the same is required to be disclosed in the return of income for the purpose of eligibility of deduction. So here, subclause A, we have covered scheduled banks, non-scheduled banks and cooperative society, wherein the amount of deduction that shall be available to them has been discussed. 8.5% of, here you can see 8.5% of total income, 10% of aggregate average advances. Then as per rule 6 ABA, the way of computation of aggregate average advances has been mentioned, and as per the two proviso, deduction available is deduction available to the specified banks is 5% of the amount of such assets, as well as a further deduction of to the extent of income derived from securities redemption of securities income derived from thereon. The deduction cannot exceed the said amount as per the third proviso, and the third proviso is required to be disclosed in the return of income for the purpose of being eligible for deduction under clause 7a. Now subclause B, C and D are related to foreign bank, is related to PFI, public financial institution, and also related to NBFC, wherein 5% of the amount of total income 5% of the total income will be allowed as deduction in the hands of such banks mentioned in B, C and D, subclause B, C and D, where obviously the provision for bad and doubtful debts has already been made in the books of accounts. Subclause B, a bank. Being a bank incorporated or under the laws of a country outside India, an amount not exceeding 5% of the total income, not exceeding 5% of the total income. The total income is before computing any deduction under before deduction of chapter 6a. So 5% of the total income in case of foreign bank, in case of PFI, public financial institution, state financial corporation or state industrial investment corporation, in case of such specified banks, again 5% of the total income. In case of NBFC, non-banking financial company, not exceeding 5% of the total income. Now friends, definition of various terms or various specified banks which has been mentioned under this subclause. Explanation. Non-scheduled bank means a banking company as defined in clause C of section 5 of Banking Regulation Act, which is not a scheduled bank. Rural branch, as we have discussed earlier, less than 10,000 population. Branch of a scheduled bank or a non-scheduled bank situated in a place which has a population of not more than 10,000 according to the last preceding census, of which the relevant figures have been published before the first day of the previous year. So less than population, not more than 10,000. Definition of rural branch. Scheduled bank definition means SBI constituted under SBI Act 1955, a subsidiary bank of SBI, corresponding new bank constituted under Section 3 of Banking Companies Act or under Section 3 of Banking Companies Acquisition and Transfer Undertaking Act 1940, or any other bank being a bank included in second schedule to RBI. It has a vast definition over here. Public financial institution will have the meaning assigned to it in section 4A of the Companies Act. State financial corporation means a financial corporation established under section 3 or 3A, or an institution notified under section 46 of the State Financial Corporation. State Industrial Investment Corporation means government company within the meaning of 617 of the Companies Act, engaged in the business of providing long-term finance for industrial projects and eligible for deduction under clause 8 of this subsection. cooperative bank, primary agricultural credit society, and primary cooperative agricultural and rural development bank shall have the same meaning assigned to them in section 80p. And NBFC shall have the meaning assigned to it under RBI Act 1934. This is the explanation related to the specified banks. So friends, this concludes clause 7a, wherein if a specified bank is making a provision, has already made a provision for bad and doubtful debts, then a certain percentage of deduction is allowed to the specified banks, which we have discussed in these provisions. Now friends, the next provision is clause 8 of subsection 1 of section 36, which is special deduction in the case of specified entities which are in eligible business. So specified entities, specified business, or rather eligible business, a special reserve is to be created as per clause 8, wherein the amount of profits are to be transferred. The amount of profits transferred should be between 1 to 20% of the profits earned during the previous year. It should not exceed it should not exceed 20%, and the amount transferred should not exceed twice of paid up share capital and general reserves. So again, the deduction is available to specified entity. It is eligible to a specified entity in a eligible business, and amount is to be transferred. The profits are to be transferred to special reserve, not exceeding 20% of the reserves. An additional condition being the amount transferred to reserves should not exceed twice the paid up share capital plus reserves. If anything exceeding twice the paid up share capital and reserves and general reserves will not be allowed as deduction under clause 8. And the specified entity will be banking institution, cooperative society other than agricultural cooperative society, housing finance corporation, which provide long-term finance. Eligible business will be long-term finance provided for infrastructure facility, for agricultural development, for housing projects. So anything basically related to infrastructure, agriculture, housing, and the specified entity which are providing the long-term finance are banking institution, cooperative society, housing society, which are into housing corporation. So on your screen, special deduction to specified entities engaged in eligible business, clause 8 of subsection 1 of section 36, in respect of any special reserve created and maintained by a specified entity. So a special reserve is supposed to be created, an amount not exceeding 20% of the profits derived, an amount not exceeding 20% of the profits from eligible business computed under the head profit and gains before making any deduction under this clause, and it is carried to such reserve account. So friends, special reserve created, amount not exceeding 20% of the profits, and it should be from eligible business, which is transferred to such reserve account. Proviso, it states the additional conditions of paid up share capital plus reserves, provided that where the aggregate of the amounts carried to such reserve account from time to time exceeds twice the amount of the paid up share capital and of general reserves, of the specified entity. No allowance, no allowance under this clause shall be made in respect of such excess. So anything in excess of aggregate of paid up share capital plus general reserve won't be allowed as per Proviso to clause 8 to subsection 1 to section 36. Explanation. It states the definition of the terms which has been used: specified entity, eligible business, infrastructure facility, and so on. Specified entity means a financial corporation specified in Section 4A of the Companies Act, a financial corporation which is a public sector company. So financial corporation will be covered in specified entity, a banking company, cooperative bank, other than primary agricultural credit society or a primary cooperative agricultural and rural development bank, a housing finance company, and any other financial corporation including a public company. So any other financial corporation will be notified or is rather notified by CBDT. So financial corporation, banking company, cooperative bank, other than primary agricultural credit society, a housing finance company, and any other financial corporation which is into the eligible business of such specified entity should be clause 1 in respect of the specified entity referred to in clause 1 financial corporation, clause 2 financial corporation, clause 3 subclause 3 banking company, cooperative bank, the business of providing long term finance for industrial or agricultural development, development of infrastructure facility in India, or development of housing in India. So industrial, agricultural development, infrastructure facility, and development of housing. Any three of these long-term finance is provided by the specified entity. Clause 2. In respect of the specified entity referred to in 5, which is housing finance company, the business of providing long-term finance for construction or purchase of houses in India for residential purposes. So construction or purchase of houses in India for residential purposes only and not for any other purpose. So the purpose should be residential purpose and it should be for construction or purchase of such houses. The eligible business for housing finance company in respect of the notified category, the business of providing long-term finance for development of infrastructure facility in India. So friends, total 3 subcategories in eligible business. First, you can say housing finance company, subclause 5, for construction or purchase of houses in India for residential purposes. Clause 6, which is nothing but any other finance corporation including a public company which will be notified by CBDT. In that case, long-term finance for infrastructure facility, and for other categories it is industrial agricultural development, development of infrastructure facility in India, or development of housing in India. So this were the definition of specified company and eligible business for the purpose of clause 8 of subsection 1 of section 36. Both the definitions have been summarized in this table. The four categories: financial corporation under section 4A, financial corporation which is a public sector company, banking company and cooperative bank other than primary agricultural credit society or primary cooperative agricultural and rural development bank. For this category, there are 3 pointers as eligible business: industrial or agricultural development, or development of infrastructure facility, or development of housing in India. A housing finance company eligible business will be long-term finance for construction or purchase of residential house in India. Last pointer is the notified category, wherein long-term finance for development of infrastructure facility in India is the eligible business. Now the banking company and cooperative bank definition. Banking company means a company to which the Banking Regulation Act 1949 applies and includes any bank or any banking institution referred to in Section 51 of Banking Regulation Act. A cooperative bank, primary agricultural credit society, and primary cooperative agricultural and rural development bank shall have the meaning assigned to it in Section PTP. Housing finance company means a public company and formed or registered in India with the main object of carrying on the business of providing long-term finance for construction purchase of houses in India for residential purposes. Public company shall have the meaning assigned to it in Section 3 of Companies Act. Infrastructure facility means pointers which are covered in subsection 4 of ATIA as well as clauses 2, 3, 4 and 6 of subsection 4 of ATIA, that is undertaking, providing telecommunication services, developing, developing and operating, maintaining and operating an industrial park or SEZ notified by the central government, and into generating, distributing, transmitting power, substantial renovation and modernization of existing network of transmission or distribution lines. So three categories: one into power, one into SEZ, and lastly the telecommunication services, which has been specified under subsection 4 of ATIA. Clauses 2, 3, 4 and 6 will be covered as infrastructure facility, and over here you can see there is clause 1 which we will be discussing in detail in subsequent slides. It is a larger category as compared to clause 2, 3, 4 and 6 of subsection 4 of section 80IA. Also, infrastructure facility includes subsection 10 of 80IB, which is an undertaking developing and building housing projects approved by a local authority. So this was the definition of infrastructure facility. Further, clause 1 of subsection 4 of ATIA. In this, what infrastructure facility is included will be road projects, highway projects, water supply projects, port, airport, inland water, inland container depot will be included as part of infrastructure facility as per clause 1 of subsection 4 of ATIA, which will be considered as eligible business for the specified entity for clause 8. So a road including toll road, a bridge or a rail system, a highway project including housing or other activities being an integral part of the highway project, a water supply project, water treatment system, irrigation project, sanitation and sewerage system a solid waste management system, and a port, airport, inland water, or inland port, or navigational channel in the sea, will be termed as infrastructure facility for clause 1 of subsection 4 of ATIA. Now, the last category that we had seen as a part of specified entity is any other facility which will be notified by CBDT. So as you can see over here, clause 6, any other financial corporation including a public company, for such category there will be eligible business as notified by CBDT. So in that case, the same has been notified by CBDT. In the case of notification of public facilities as infrastructure facilities for the purpose of 3618 notification of July 2006. So additionally, these pointers will also be part of infrastructure facility, which includes inland container depot and container freight station notified under the Customs Act, mass rapid transit system, light rail transit system, expressways, intra-urban or semi-urban roads like ring roads or urban bypasses of flyovers, bus and truck terminals, subways, road dividers, bulk handling terminals which are developed or maintained or operated for development of rail system, multi-level computerized parking will be part of infrastructure facility as notified by CPDT in July 2006. Also, conditions to be satisfied for such public facilities or conditions to be eligible to be notified as infrastructure facility will be, for the purpose of notification, the conditions is the company, the corporation should have an Indian connection, it should be formed and registered in India, or it should be developed through joint venture in India, or it should be owned by government or local authority of India. And second pointer being an agreement should be entered with the central government or state government. Also, the operation, the activities should have started post April 1995. These are the additional conditions. These are the conditions to be satisfied by the company, by the corporation to get itself notified for infrastructure facility. Conditions to be fulfilled by public facility to be eligible to be notified as infrastructure facility. Rule 6ABA, Rule 6AB has been inserted, which specifies the conditions to be fulfilled by public facility to be eligible to be notified as infrastructure facility. A public facility will be notified as infrastructure facility only if, in accordance with the provisions of clause D of explanation to clause 8 of subsection 1 of section 36, the conditions specified therein are: it is owned by a company registered in India or by consortium of such companies, of such Indian companies, or by an authority or a board or corporation or any other body established or constituted under the Central or State Act. So, company registered in India or consortium of such companies or such Indian companies or authority, board, corporation or any other body established under the Central or State Act, basically an Indian connection. It is entered into an agreement with the central government, state government, local authority, statutory body, developing, operating and maintaining a new infrastructure facility similar in the nature to an explanation, similar to the nature to an infrastructure facility referred to in explanation to section 80IA. So basically it should be in infrastructure facility as mentioned in clause 1 of subsection 4 of 80IA, which is nothing but road, highway project, which were mentioned over here in this category. Clause 1 explanation to clause 1 of subsection 4 of 80IA. This is what is being covered as part of the conditions over here, wherein the agreement should be with central, state government, local authority, statutory body, and you should be into developing, operating, and maintaining a new infrastructure facility, which is covered in explanation to clause 1 of subsection 4 of section 80IA. So second condition is agreement. Third condition is the infrastructure facility. It has started or starts operating and maintaining such infrastructure facility on or after 1st of April 1995. So these three conditions are to be satisfied for public facility to be notified as infrastructure facility. So friends, we have done the conditions. We have done the additional notification for public facilities. Then we have covered definitions which are covered in subsection 4 of section 80IA and other definitions mentioned under the provisions of clause 8. Now amount withdrawal from special reserve in section 41 4A, which will be taxable in 41 4A. Basically what section 41 4 is trying to say is any special reserve withdrawn from the account which has been mentioned in clause 8, any amount withdrawn from such special reserve shall be deemed to be profit and gains of the entity under section 41 4A. And if the amount is withdrawn even if the business is no longer in existence, then also it will be assumed that as if the business is in existence, and the amount will be subject to tax in the previous year in which the amount is withdrawn by the specified business. Where a deduction has been allowed in respect of any special reserve created and maintained under section 36(1)(8), and subsequently the amount is withdrawn from such special reserve, then such amount shall be deemed to be profit and gains of business or profession and will be chargeable as income of the previous year in which the amount is withdrawn. If the amount is withdrawn in a previous year in which business is no longer in existence, the taxability would arise in the above manner as though the business is in existence and accordingly subject to tax. Long-term finance means any loan or advance where the terms under which the monies are loaned or advanced provide for repayment along with interest thereof during a period of not less than 5 years. So the period for long-term finance is not less than 5 years, and it's in the nature of general loan wherein the principal amount is supposed to be paid along with interest, and the validity of long-term finance should be more than 5 years. So friends, this concludes section 36(1) clause 8. So friends, what we have studied in section 36(1)(8) is the amount transferred to special reserve account out of the profits will be eligible for deduction up to 20% of the profits transferred, and it is applicable only to specified entity in eligible business. Specified entity were mentioned as financial corporation, banking institution, cooperative society other than agricultural credit society, which will be part of specified entity, and eligible businesses long-term finance for industrial rural development, agricultural development, long-term finance for housing projects, infrastructure facility. So that will be part of deduction under clause 8 of 36(1). Further, this was the definition of specified entity and eligible business, and we have studied definition of infrastructure facility in detail, wherein subsection 4 of section 80IA is getting covered, which includes road, highway project, housing project as part of infrastructure facility. Further, subsection 4 of section 80IA includes telecommunication, SEZ, developing, maintaining, operating SEZ, generating, distributing, transmission of power. Subsection 10, section 80IB, which is into housing projects, developing, building housing projects approved by local authority. Also, there was a notification wherein the public facility will be notified as infrastructure facility. The public facility included inland container depot, light rail, mass rapid transit system, expressways, bus and truck terminals, subways, road dividers will be part of the infrastructure facility, and certain conditions are required to be satisfied for infrastructure facility, which included an Indian connection. An Indian company will be eligible to it. There should be an agreement with central or state government, and the activities, the infrastructure activities should have started post April 1995, and thereafter any amount withdrawn from special reserve account will be taxable in the hands of the company in the year of withdrawal, even if the business is not in existence. So friends, this concludes section 36.1 clause 8. Friends, now the next clause, which is subclause 9 of subsection 1 of section 36, which is related to family planning expenditure by a company, wherein the purpose of the intention of the provision is to encourage the employees of the company for family planning. In this regard, any expenditure incurred by the company, whether revenue or capital expenditure, will be allowed as deduction to the company. If it's a revenue expenditure, then 100% deduction will be allowed in the year, in the concerned previous year itself. If it's a capital expenditure, then deduction will be allowed in 1/5 portion, starting with the previous year in which the deduction has been incurred, and followed by succeeding 4 previous years. Also, as per provisos, the unabsorbed capital expenditure. Any unabsorbed family planning expenditure will be similar to the treatment of unabsorbed depreciation, wherein it will be allowed to be carried forward to indefinite number of years. So the treatment will be similar to unabsorbed depreciation. Also, if any asset has been sold, if any asset which is in the nature of capital expenditure, which is related to family planning expenditure by the company, such asset when it is sold, the treatment is similar to scientific research capital expenditure. Accordingly, any profit from transfer of family planning capital expenditure will be treated as business income to the extent of capital expenditure claimed under clause 9. So the treatment is similar to scientific research capital expenditure, and the same, and the business income which is being reversed, the deduction which is being reversed will be taxable under section 41 of the Income Tax Act. On your screen, clause 9, any expenditure bona fide incurred by the company for the purpose of promoting family planning amongst its employees. It covers the revenue expenditure, provided that where such expenditure or any part thereof is of a capital nature. In such a case, 1/5 of such expenditure shall be deducted for the previous year in which it was incurred, and the balance thereof shall be deducted in equal installments for each of the 4 immediately succeeding previous years. So for capital expenditure, 1/5 is the portion which will be allowed in the previous year, and it will be followed by 4 succeeding previous years. Next proviso is related to the treatment similar to unabsorbed depreciation, provided further that the provisions of subsection 2 of section 32, which is related to unabsorbed depreciation, and of subsection 2 of section 72, which is related to carry forward of the depreciation, shall apply in relation to deductions under this clause as they apply in relation to depreciation. So treatment will be similar to unabsorbed and carry forward of depreciation of the unabsorbed expenditure on family planning. Provided further that the provisions of clause 2, 3, 4 and 5 of subsection 2 and subsection 35, which is scientific research expenditure, and subsection 3 of section 41, in subsection 41, any asset which was used for scientific research purpose is subsequently sold within the specified period, then the same will be subject to tax. The business income will be subject to tax. And explanation 1 to clause 1 of 43, which is related to the actual cost of the asset, meaning the asset value, the cost value will be treated as nil when, for the purpose of, when the asset is transferred from scientific research purpose, or in this case a family planning capital expenditure asset is transferred for other business purposes of the SSC. In such a case, the actual cost will be subject to any notional depreciation, assuming that such business was used for the purpose of business initially. So basically a notional depreciation will be calculated and actual cost will be reduced, effectively reduced. Hence section 43. So friends, 3 sections: section 35, section 41 and section 43 shall apply to family planning capital expenditure asset as well. Shall, so far as may be, apply in relation to an asset representing expenditure of capital nature for the purpose of promoting family planning, as they apply in relation to scientific research capital expenditure. So friends, family planning expenditure, in this case the companies allow deduction for encouraging its employees for family planning, and the expenditure will be revenue as well as capital expenditure. Capital expenditure will be allowed deduction in installments of 1/5 in the previous year, and provisions of unabsorbed depreciation and scientific research asset being sold. The treatment will be similar to unabsorbed depreciation for the unabsorbed family planning expenditure, and treatment of scientific research asset being sold will be similar to family planning capital expenditure asset. Now next provision: deduction for expenditure incurred by entities established under Central State Provincial Act. So clause 12. In this case, any expenditure incurred by an entity, by a corporation, by statutory body which is established under state, central or provincial act, and the expenditure has been incurred for the objects and the purpose. The expenditure has been incurred for the objects and the purpose which are authorized by the act, then any expenditure incurred by such entity which is controlled by central, state or provincial act by such entity will be allowed as deduction under clause 12. On your screen, any expenditure, not a capital expenditure, incurred by a corporation, body corporate, by whatever name called, if it is constituted or established by a central, state or provincial act, such corporation or body corporate having regard to the objects and purpose of the act, which is notified by the central government in the official gazette. So first condition being established under a central, state or provincial act. Second, it should be notified by the central government in the official gazette. Third, the expenditure is incurred for the objects and purpose authorized by the act under which it is constituted. If these conditions are satisfied, then deduction of such an expenditure will be allowed to specified entity, and till date central government has notified Oil Industry Development Board for the purpose of deduction, which is referring to the second condition over here, that it should be notified by the central government in the official gazette. So till date Oil Industry Development Board has been notified for the purpose of deduction under clause 12. Next, clause 14, deduction of contribution by PFI, Public Financial Institution, to Credit Guarantee Fund Trust for Small Industries. So here, public financial institution will be eligible for deduction under clause 14, wherein amount is transferred to a fund for the benefit of notified small industries. Any sum paid by a public financial institution by way of contribution to such credit guarantee fund trust for small industries as notified by central government. The amount is transferred to credit guarantee fund trust for small industries which are notified. Public financial corporation is nothing but as defined in section 4A of the Companies Act. Next, deduction of STT paid, which is under clause 15. Here, any STT paid by an entity which is into the business of taxable securities, meaning while dealing, for example, while dealing in shares, you are a dealer in shares, your profit and gains is taxable under this heading, profit and gains from business of profession. So there is income from taxable securities. Accordingly, any STT paid by such dealer will be allowed as deduction against the taxable securities. So deduction is provided under subclause 15. However, if you are not in the business of dealing of shares and securities, for example, if I am investing amount in share market, then I will not be allowed any deduction of STT paid, only because I am not a dealer in shares and securities. So deduction will be allowed only to a dealer in shares and securities, and the same will be allowed in clause 14 of subsection 1 of section 36. On your screen, deduction of STT paid, an amount equal to STT paid by the SSC in respect of taxable securities transactions entered into the course of business. Taxable securities transactions entered into the course of business, basically any income from selling of securities, whether it is taxable in your hands under business of profession or capital gains. If it is business of profession, then deduction of STT paid will be allowed. If taxable securities income is taxable as capital gains, then STT paid deduction won't be allowed. The deduction will be allowed during the previous year if the income arising from such taxable securities transactions is included in the income from profit and gains of business or profession. Explanation: for the purpose of this clause, STT and taxable transaction securities shall have the meaning as defined in Finance Act 2004. Deduction. Now the next clause is 16. Deduction of Commodities Transaction Tax. Even here, the same concept will apply. If you have income from taxable commodities, from dealing in taxable commodities, then you will be allowed a deduction of CTT paid, which is Commodities Transaction Tax, will be allowed to you. However, if nothing is taxable in profit and gains from business or profession on account of dealing in taxable commodities, then deduction of CTT won't be allowed under clause 16 on your screen. An amount equal to Commodities Transaction Tax paid by the SSE in respect of taxable commodities transactions entered into the course of his business. So taxable commodities transaction entered into the course of business during the previous year and CTT paid thereon will be allowed as deduction to the SSE, and such income should be from taxable commodities transactions is included in profit and gains of business or profession. Here, the taxable commodities transaction means a transaction of sale of commodity derivatives in respect of commodities other than agricultural commodities traded in recognized associations. So commodities transaction is transaction in commodity derivative which is other than agricultural commodities. And in explanation, the definition of CTT and taxable commodities are specified in Finance Act 2013. So friends, clause 15 and clause 16, deduction of STT and deduction of CTT respectively will be allowed to a person who is paying such tax where there is taxable securities or taxable commodities transaction respectively, and the same is taxable under the head profit and gains from business or profession. Now the next provision, amount of expenditure incurred by cooperative society for purchase of sugarcane for the benefit of its members. If any cooperative society purchases sugarcane and the same is at a price which is equal to or less than the price fixed by the government, then a deduction will be allowed of the amount of expenditure incurred for purchasing such sugarcane. So friends, on your screen, clause 17, the amount of expenditure incurred by cooperative society engaged in the business of manufacture of sugar. So the purpose is manufacturing of sugar and the expenditure has been incurred for purchase of sugarcane and the price should be equal to or less than the price fixed or approved by the central government, by the government. So the price of purchasing the sugarcane should be equal to or less than the price fixed by government, and such sugarcane has been purchased for the manufacture of sugar and the expenditure is incurred by cooperative society. If yes, then under clause 17, amount paid by the cooperative society for purchasing sugarcane will be allowed as deduction. Next point is marked to market loss. So friends, clause 18, wherein marked to market loss or any expected loss or any other expected loss which has been provided as per the requirement of ICDS, then any loss therein, any mark to market loss therein will be allowed as deduction under clause 18. On your screen, clause 18, mark to market loss or other expected loss as computed in accordance with ICDS of section 145, subsection 2. ICDS 1 provides, these wordings have been a part of additional notes. ICDS 1 provides that mark to market losses would not be allowed unless the same is in accordance with any other ICDS. So as per the requirement of ICDS, they are providing mark-to-market loss, and such provision as per the requirement of ICDS will be allowed as deduction under clause 18. So friends, this concludes section 36.1, and thereafter we'll be considering several illustrations on section 36.1. So friends, the illustration which are part of section 36.1 on your screen. Come Limited contributes 15% of basic salary to the account of each employee under a pension scheme referred to in section 80 CCD. So 15% of the basic salary is contributed under section 80 CCD by the employer as an employer contribution. The earners allowance is 50% of basic salary and it forms part of pay of the employees. Accordingly, it will be considered for the purpose of calculation of ETCCD. ETCCD is nothing but a pension scheme notified, and the contribution wherein a deduction will be allowed to the employer will be to the extent of 10% of basic salary or dearness allowance, basic salary and dearness allowance paid to the employee. So the limit is up to 10% of basic salary and dearness allowance together. And here we can see Come Limited contributed 15% of the basic salary of each and every employee. So anything in excess of 10% of basic salary and dearness allowance won't be allowed as deduction under section 36.1 4A clause 4A. It will be disallowed under section 40A9. Compute the amount of deduction allowable under section 36.1 4A. If the basic salary of employees aggregate to 20 lakhs, would disallowance under section 14A9 be attracted, and if so, to what extent? So, two questions. Amount of deduction under section 36.1 4A, basic salary is 20 lakhs and disallowance under section is to be computed. So anything in excess of 10% of basic salary and DNS allowance paid to the employee will be disallowed under section 40A9. Read with section 36.1 4A. So friends, let's compute the solution. In this, first limb is basic salary, which is 20 lakhs, DNS allowance, which is 50% of basic salary, so it is 10 lakhs. Now contribution to ATCCD by the employer is 10% of basic salary and DNS allowance, which is part of the agreement of the SSC of the employee. So here we will include the DNS allowance, which will be 10% of 30 lakhs, 20 plus 10, so 30 lakhs. So 10% of 30 lakhs is nothing but 3 lakhs, and actual contribution by the employer is nothing but 15% of basic pay as mentioned in the problem. So it will be basic pay is 20 lakhs, so 3 lakhs is the actual contribution by the employer. The second, 20 lakhs into 15%, it's 3 lakhs only. So here we can see that it is within the limit. Here we can see that it is within the limit prescribed by APCCD. So nothing will be disallowed in the hands of the company, in the hands of the employer company. So as per the solution, amount of deduction under section 36(1)(4)(a) is 3 lakhs and nothing will be disallowed under section 40(a)(9) because nothing is exceeding as per the limit prescribed. Amount disallowed under section 40(a)(9) will be nil if, friends, considering a situation wherein if assumption, just for your explanation, the solution is already over. Just for your assumption, if at all, in the assumption, this amount, let's take it that the actual contribution by the employer was 5 lakhs and not 3 lakhs. So after computation of basic salary, 15% of basic salary, assume that the actual contribution by the employer was 5 lakhs, then the deduction allowed under section 36(1)(4)(a) will continue to be 3 lakhs and 5 lakh minus 3 lakhs, 2 lakh amount will be disallowed under section 40(a)(9). So I hope you understood the disallowed portion under section 40(a)(9) and which portion will be allowed as deduction under section 36(1)(4)(a). So friends, this concludes the illustration. Now the next one. Now friends, the last illustration on your screen. Compute the deduction allowable under section 36(1)(7) for the assessment year 2021 based on the following particulars in respect of scheduled bank incorporated in India. First is provision for bad and doubtful debts under section 36(1)(7)(a) up to AY 1920. So it's the opening balance of provision for bad and doubtful debts. Second, gross total income for AY 2021 before deduction under 36(1)(7)(a. Aggregate average advances made by rural branches of the bank and bad debts written off for the first time in the books of accounts in respect of urban advances only during the previous year 1920. So here the word urban advances, it doesn't matter whether bad debts has been written off for urban or rural advances. For the purpose of deduction under section 36(1), any bad debt written off will be considered. So on your screen, the solution will be, we have to compute the deduction allowable under section 36(1)(7). For that purpose, as we have discussed earlier, that the deduction under section 36(1)(7) will be allowed to a credit balance of bad debts written off which is in excess of provision for bad and doubtful debts. So bad debts written off will be compared with the existing balance of provision for bad and doubtful debts, and if there is any excess amount, only if there is any excess amount over bad debts written off as compared to provision for bad and doubtful debts, then that will be allowed as deduction under section 36(1)(7)(a). Under section 36(1)(7). So bad debts written off, which is 170 lakhs. Now this will be compared with the closing balance of provision for bad and doubtful debts, which is less provision for bad and doubtful debts. So friends, first is opening balance, which is nothing but 50 lakhs. Then provision during the year. It will be computed as per section 3617A, as per section 3617A, wherein to a scheduled bank provision of 8.5% of the total income and 10% of aggregate average advances made by the rural branches will be allowed as provision for bad and doubtful debts as per section 3617A. So 8.5% of total income, which should be before deduction under section 3617A, which has been mentioned over here as 600 lakhs into 8.5%, which will be 600 into 8.5%. My mistake. Again, 600 into 8.5% is 51 lakhs, and 10% of aggregate average advances, which will be 10% of 200 lakhs, which is nothing but 20 lakhs. The total provisions during the year is 51 lakh plus 20 lakhs, so it will be 71 lakhs, which will be added to the opening balance, which is 50 lakh plus 71 lakhs. Total amount will be 121 lakhs, and this is the credit balance in the provision for doubtful debts, 121 lakhs, and the amount written off as per section, and the amount written off during the previous year 1920 for the first time is 170 lakhs. Anything excess of provision will be allowed as deduction. Accordingly, 170 lakhs minus 121 lakhs. First of all, total provision for bad and doubtful debts. For bad and doubtful debts will be 50 lakhs plus 71 lakhs, which is provision during the year. It is nothing but 121 lakhs. Accordingly, total deduction under section 3617, total deduction allowable under section 3617 will be 170 lakhs minus 121 lakhs. 121 lakhs is the balance of provision for bad and doubtful debts, and it is nothing but 170, just a minute, 170 minus 121 is equal to 49, is the amount allowable as deduction under section 3617, meaning deduction allowable under section 3617 wherein an entity is required to make provision for bad and doubtful debts. In such cases, only the excess balance of bad debts will be allowed as deduction to the SSC, which in this case is 49 lakhs. which will be allowed as deduction under section 36(1)(7). So friends, this concludes the last illustration in 36(1) deduction. So this concludes the discussion, the series on subsection 1, section 36, and thereafter we'll be studying section 37, the residuary section. Thank you.